Great stuff. Okay, we are live right now. We're gonna start in a few seconds. Attendees are coming in quick and fast. I'm gonna put the poll out. Okay. Good afternoon, everyone, all our dear attendees. Thank you again for joining us this afternoon on the second episode of Gen Zooms. Very, very delighted to have here with us our esteemed panelists, Steve Melhuish, who is venture partner of Wavemaker, as well as former CEO and co-founder and former CEO of Property Guru. We've got Velisarios, who's a recovering founder and CEO of Lantern, Kristin, who's director of investments at Funnel, and Junxian, who's co-founder of MoveVest. Today's episode is called Show Me the Money, Secrets of Startups That Raise Money During COVID-19. The whole idea here really is to share war stories of success to empower you, the attendee, whether it's your fundraising or any area in your life. If you have the right mindset, you definitely can go get it. So without further ado, I am going to get our esteemed panelists to introduce themselves. So on my screen, I can see Steve at the top, so I'll let him go first, followed by Kristin, Veli, and then Junxian. Steve, over to you, please.
Thanks, Martin. Hello, everybody. I'm Steve Melhuish. As Martin said, I'm a founder entrepreneur with three startups. Most recently, Property Guru, one of the few profitable tech unicorns in the region. I'm also an angel investor. I've been angel investing for the last 15 years or so, in about 22 startups, and made about 4 investments in the last couple of months or so. And also LP and venture partner at Wavemakers. So Wavemaker Partners, which is a Southeast Asia focused VC. We focus on predominantly B2B, early Series A kind of stage, about 120-ish companies we've invested to date over the last about 10 years. Everything from software to AI to cybersecurity, clean tech, additive manufacturing, laser communications, you name it. And 4 exits in the last 12 months and a few investments in the last 2 or 3 months during COVID-19 as well.
Over to you, Kristin.
Great. Thanks for having me, Martin. It's a pleasure being here today with all the other esteemed panelists. I'm Kristin. I'm the Director of Investments at Funnel. We are a private fundraising platform and we help companies and funds to raise capital.
Veli, over to you.
Hi, I'm Velisarios Kattoulas. I'm the CEO of Lantern. As Martin said, I'm a recovering founder. I think I've founded, co-founded, or had senior roles at about 6 startups, and I've run and exited startups in Tokyo, Hong Kong, and Singapore. I've been with Lantern now for just over a year. And separate to that, I'm also an angel investor, and I'm a venture partner at Antler, which is an early stage VC, I think the world's largest startup generator.
Junxian, over to you.
Yeah, thanks, Martin. So my name is Junxian. I'm a co-founder and CEO of a company called MoveVest. In MoveVest, we basically Uberize cross-border relocation. So we empower like human mobility, and we see a lot of that in tech, right? Like a lot of engineers coming from different countries. Either that or they are working remotely. So we are basically the operating system that manages the logistics behind most of this. I first started out in venture investments in a CVC, and then subsequently went on to do operations. So this would be my 4th startup, that I'm operating in.
Fantastic. So before we go into the more exciting bits, just a little bit of housekeeping for our attendees, especially. Feel free to ask questions in Q&A. We will we'll bring the questions in during the session so that it's a little bit more interactive. And you also can let your friends know that we are beaming on Facebook Live for Genesis Alternative Ventures. Apologies, I forgot to introduce myself. My name is Martin Tang, co-founder and partner of Genesis Alternative Ventures. We are Southeast Asia's premier venture debt fund, and we focus on providing debt capital to empower growth and minimize dilution for the region's best startups. Right now, let me share a little bit about why I'm doing this episode and why the title. So, secrets of startups that raise money during COVID-19. In the past month, I've noticed a lot of startups raising very, very large rounds. Series A, Series B, if you compare to earlier different rounds of Series A and B, these are larger rounds. And I'm sure a lot of founders are realizing that with COVID being rather uncertain, it's better to have more cash in bank just to ride out what may be a longer winter. So, but then on the other hand, there are some startups that are struggling to raise money. They have faced rejection by a lot of the VCs, by their angel investors, whatnot. But yet, if you put two startups side by side, the difference in quality, product offering may not be that different, but yet one raises 10 million, the other one raises 1.5. So, it's just very interesting. So was it luck? Was it because the founder was prettier, more handsome, he speaks well, or sells well? What is it? So I thought about it, and maybe we should ask the experts on the ground, Steve, Kristin, Veli, as well as Junxian. I'm sure you have a lot to share. So let's start with this state of play, right? So maybe Steve, can you, for Steve, well, maybe this is really a question for Steve, Veli, and Kristin, because you are also on that investment side. Can you talk a bit about the state of your business during these times? I'll let the lady go first.
Sure. We are busier than ever. I think you're definitely right. I think a lot of companies are realizing that this is going to be for the long haul. And while they're in a good financial position, it's important that they raise more cash to have, more ammunition in their war chest, right? But I think, interestingly, a lot of companies are also very careful about positioning now. So I think optics about fundraising during COVID is also something that comes into play a lot, right? You don't want to be seen as desperate, for funds or being some kind of distress opportunity. So I think a lot of companies now are very careful about how they are having investors view them, and are very clear that they want to caveat that, we're not desperate, we have a good runway, we just want to make sure we're shoring up on our reserves.
Right. Steve, anything that you've seen you'd like to share?
Yeah, I think not that much has actually changed, to be honest. I think some things have, some things haven't. I think the volume of deals continues to be strong. I think we're seeing, if anything, maybe slightly more deals than before. I think the consequences of COVID-19, a couple of months ago, probably put the brakes a little bit on some of the fundraising processes that were taking place. So things did grind to a halt a little bit. So April and May time, particularly I think as VCs focused a little bit on existing portfolio and making sure that the existing portfolio is going to survive. Certainly with my wave maker hat on, I spent some time looking at the ones that had runway for the next 12, 18 months, the ones which suddenly saw runway disappearing very rapidly. And generally those companies, were the ones that we obviously wanted to focus on and make sure we could continue to support. And similarly on the personal level, some of the companies supported to make sure they would survive the next 12 months. I think we've seen funding sizes reduce slightly in some cases, or being restructured, and We're seeing restructuring of those deals, but the VCs and investors have raised a few $1 billion, and those dollars going to find homes, and so the good quality companies are still getting invested. Wavemakers invested in 3 or 4 companies in the last 2 months. Most of those were processes that started just pre-COVID-19. Our person invested in 3 or 4 companies in the last couple of months as well. And so, I think we're still seeing businesses get funded, but it's, I guess probably a bigger focus around quality. The quality threshold has gone up, and therefore I think the decision-making process takes a little bit longer than perhaps it was before. Companies are still getting funded, which is good news.
Right, flight to quality. That's one key word that I keep hearing and reading these days. Veli, from your business, the unique business that you run, maybe can you just share a little bit about what Lantern does to the audience? Then you can.
Yes, sure. So we're an online corporate services firm. We work with, I guess, just under 400 companies, many of them early stage, seed, Series A, pre-Series B, some Series B. And there's always multiple companies that we work for raising money at any one time. I would agree with both Kristin and with Steve. I don't think there's been that much change yet, because I think a lot of the funding rounds that we've seen closed in the last 6 months, all of these processes had started sort of Q4, Q3 last year. I think the changes, if there are any, are going to come second half of the year, first half of next year, and that will be kind of interesting to see. I agree. Quality is always been important, but I think quality is more important now than it's ever been. But I think that one of the things I feel is that the startup economy isn't in sync with the mainstream economy. The near collapse or the fall from grace of WeWork in September last year probably had as big an impact on fundraising and on investor mentality as COVID-19. So COVID-19 is just an extra layer of pain on top of what was already a fairly difficult environment. And I think sort of post WeWork blow up in sort of September last year, there has been this emphasis on quality. And I think there has been an emphasis on, and not just in Singapore and Southeast Asia, but in the US as well. Exactly what Steve said, there's a stronger emphasis on existing portfolio companies and on companies with strong runway that investors think can get through this economic slowdown and thrive when things bounce back.
Right. And Fish, you're the only true blue entrepreneur on this panel right now.
Right now.
Right now.
Actually, each of them are entrepreneurs.
On this panel, they are in their own right, but you're the only one that doesn't have that 2 hats, right?
Yeah.
And you've announced your fundraising just recently. Congratulations. Are investors generally still open to taking meetings? Have you seen? Are they rejecting meetings in the last 2 months that you're on the road?
So no, actually we do have more meetings now. It's a lot easier to schedule like shorter meetings online, right? So
right.
Yeah, but I think the challenge maybe that I personally face is that conversion rates are very low. So I do think that maybe investors are open to like getting more information, right? Finding a lot more about your startups, but I don't think deployment is as active as it used to be. Yeah, and it could be because like I think like Veli and Steve shared, the criteria maybe has tightened, right? So one of the things that I think we experienced, and we kind of like closed around amidst COVID, right? We did start in Q3, Q4 last year, so like Veli shared. But the additional requirement that came out is like, hey, this was the business model, right? But what is your business model going forward? Because I think the kind of like the commitment is there, but they still want to know that you're going to survive this and you're optimistic about the future, you're nimble enough to figure it out. because obviously things are gonna change, right? It's either gonna work in your favor, or it's gonna work against you. So they're trying to figure out which one you are. So I think for us, like, yeah, what was important is really like kind of like steadying the ship, right? Still being able to be confident about the business model. These are the areas we need to tweak. These are the problems that we might have to resolve, and these are, you know, maybe some of the revenue streams that we might have to cut. And being very realistic about it, I think was helpful in giving investors confidence that, you know, this team is still the right team. Once again, we're a Series A company, so we're still an early stage company, and I do think like yeah, investors are looking to invest in a team that they know can steer through all these like troubled waters.
Oh, definitely.
I mean, I would agree with what you just said. I think you know, investing in startups, and particularly early stage startups, is a challenging job anyway, right? You're trying to predict the future. You're trying to bet on the founders and the founders team and the business. And then COVID-19 comes along and adds a layer of uncertainty to already an uncertain process, right? So I think there's certainly, from my perspective, increased focus around what does COVID-19 really mean to your business, short, medium, and long term, and trying to drill behind that to understand short, medium, and long-term forecasts, and does the business apply more or less in a COVID world in the next 18 plus months.
So never has the words what pivoting, fail fast, change fast been more true, huh?
Right.
So I just want to open up that poll that I did earlier on. Let us try to get to know our audience. So we've got 59% of our audience are entrepreneurs. The 23% are investors. 28% haven't decided. Then my second question, if you're an entrepreneur, has your company raised funding from a VC or other institutional investors? So we've got 20% who said yes, and then another 80% who said no. And my third question, and this is interesting, it was half-half. If you are an entrepreneur now, are you in the midst of fundraising and need some advice or tips? So 50% said yes, 50% said no. So for the 50% who said yes, you know where to find us. And the fourth question, if you're an investor, are you actively deploying? Would you like to find out more about available investment opportunities? 48% said yes, please call Kristin, please call Steve, please call Veli. And also give Junxian a call. And for the ones that said no, hopefully we can interest you with some other opportunities further down the road. And the last question, obviously, I had to ask this. Are you still working from home? A resounding 78% have said yes. Okay, now back to questions. So we talk about state of play in the business right now. You know, what are some of the things and trends that you have seen in the last months that surprise you? So again, you know, this question really be more for the investors, right? Are you seeing valuation expectations come down? Are you also seeing more innovative structuring like earnouts or tranching and whatnot? Maybe Kristin, you take that first.
Yeah, sure. I think valuation expectations, definitely. I think it is a little bit lower. And this is probably something that is not unexpected, right? Given the uncertainty that COVID has brought about. On our end, when it comes to innovative structuring, we're actually thinking about it from the investor side. So Funnel doesn't invest, we don't have our own money to invest. So we show opportunities to our network of 13,000 investors. So because of that, we are always actively thinking about what our investors want, right? So we really aim to kind of bring them opportunities that line up with their mandates and match up with what they are looking for. And I think it's really a supply side push for us to innovate rather than demand side push. So for us, we are kind of thinking about, okay, can we provide things that are, say, smaller ticket sizes, right? Like how do we encourage people with spare cash, you know, high net worth to come out of the woodwork and kind of look at opportunities they may not otherwise have. We're also looking at more novel types of structures, you know, let's say like yield-based structures, right? A lot of people are looking towards, you know, something that's a bit more predictable compared to just straight equity. So can we provide something that's a little bit more debt-like in nature, a little bit more yield-based, provides a bit more certainty and fixed returns even. So that's something we've been experimenting with, and we'll probably roll some stuff out over the next couple of months around that.
Right. Steve?
Yeah, I agree with Kristin. I think so. That I guess it depends on. It's a little bit contextual. So it depends a little bit on the company, and I think what we saw was companies which were smaller and earlier stage, their ability to survive was actually not too bad because they're running on fumes anyway. They hadn't quite scaled, and so the smaller companies are okay. The bigger companies, which are in the Series B plus, already had the scale. They had probably some larger investors with some deep pockets. I mean, but really it was the medium-sized companies which were the ones who were struggling. Those are the ones who were growing at 2 or 3x every year, loading up on the cost because they're building leadership team or expanding across multiple markets, and suddenly then the runway disappears. And so depending on the context, I think that kind of also shaped a little bit what happened in terms of investment process. I think generally what's happened, what I saw happen was valuations expectations actually on both sides reduced. In extreme circumstances, depending on whether it's a rescue raise or whether it's not a rescue raise, but in case of rescue raise, as much as 70% reduction in the valuation comp from before. So one company I was working with, which is a prop tech related company, had raised at a certain level the last round, needed $300,000 to just get through the next 12 months on a minimal skeleton organization, and then reduced the raise down by 70%, and then was massively oversubscribed and ended up having a tiered fundraise. So for the first 300 to 400,000, it was an X valuation, and the valuation went up. So by the end of that process, they'd raised 5 times more money than they wanted, but actually the average valuation was close to where it was beforehand. Another company, which is a wave maker company, the valuation was flat versus 2 years ago, despite an 8x growth. But restructured from a Series A round to a bridge to the Series A. So rather than raising $4.5 million, raises $1 million at a flat valuation ahead of a delayed Series A, and again oversubscribed. And then in another case, another wave maker, new investment that we announced about 2 or 3 weeks ago, a company which was badly affected by COVID-19. Obviously some unscrupulous investors could have taken advantage of that and restructured the whole deal process. But we kept the same valuation, right, but just changed the structure a little bit. So with some tranches. So the first tranche is a certain valuation, and if the business continues to grow as I was hoped, then it would be at a higher valuation. So kind of a tranche-based approach. And then in one case, which is again a personal investment, what's happened because the company wanted to do a Series A, pull the plug on that, and decided to do a debt financing round on their own. So they went out to the existing shareholders and said, "Look, how about we create some venture debt ourselves?" And the existing shareholders and a couple of family offices, stumped up $2 million worth of debt. To enable a company to go from a sort of a hardware sales to a software as a service kind of business model, obviously has negative cash implications. So I'm seeing that kind of thing take place. And so some new approaches, I guess, but generally speaking, bridge rounds, smaller rounds, delayed to the bigger round at a reduced valuation, mostly convertible notes with some debt venture.
So, Steve, we've got a live question right now. Could you please describe what a bridge to Series A means in practical terms?
So if a company's raising, call it $5 million as a Series A round, which was maybe the original plan pre-COVID-19, what some companies I've been working with have done is basically put that on hold and said, okay, so what do we need for the next 12 to 15 months? And let's say it's $1 million. So rather than raise the Series A 5 million, you raise 1 million bridge round. And that bridge round then typically is a convertible note. It's a discount to the future round. typically the valuation is relatively depressed or flat versus the last round. And then the expectation is that as we enter in 2021, as a business survives or hopefully grows during that period of time, then they can restart the Series A process at that point. Does that kind of answer the question?
Well, I think so. He hasn't protested. Veli, with you, I get 2 for the price of 1. You've got that, venture partner hat, and the, from your business, you have that 30,000 feet view of the companies you look after. Anything interesting you're seeing?
Again, very similar to what Steve and Kristin have said. There is, I think, a growing preference for debt-like structures or structures that involve debt, so convertible notes. We haven't seen sort of yield-based investments yet. I'm sure that will kind of pop up at some point, but we are seeing investors who are focusing on making sure that they are, if not secured, at least senior in the capital stack, particularly for kind of slightly later stage companies that already have strong cash flow and are growing quite briskly, because obviously that gives investors, for people not familiar with these structures, a lot more security in the event of either a sale of the business or a default. So yeah, I think people are kind of creeping into the Genesis space, is what it feels like.
My partners are getting nervous right now. No, just kidding. Junxian, anything you're seeing that is interesting? Like we talk about investors, are they, taking long time to say yes, or rather saying no very quickly, or they're asking for, deals where you're structuring deals with earn-outs, take less money now, but if you perform later, I'll give you, a premium to the valuation you're asking for. Are you seeing those things?
Maybe not so much for us, because like a lot of our terms were set earlier on, and our investors did follow through with it. So we're thankful for that. But I think like maybe from an operator's perspective, I do think now it's a lot more difficult to convince investors, right, that you are the right one. Yeah, and the challenge we face is that amidst a very, very bearish market, like as a company, we still need to prove growth, optimism, and at least the potential of which, right? I mean, even if I were an investor, I wouldn't want to invest into something that I think is not going to make it, right? So despite that, we're going to have to, like amidst the bearishness, I'm going to have to prove bullishness, right? One way or another. Right. Yeah, that's the only way the conversation starts. So I think creative structuring is definitely one way to go about it, right? Whereby, hey, I think like Steve mentioned, you can tranche it, right? And but you do need to do it in 3 steps rather than one fell swoop, right? Mm-hmm. I think other things that work well for us to create bullishness is probably consolidation. Amidst like difficult times, there are quite a few of our peers, right, that are struggling. Yeah, and this is kind of like the best time for us to lean on each other, whereby, the sum of our parts might be, the sum of the whole is greater than the parts, right? So we're having a lot of these conversations whereby, hey, this might be the best time for us to start working together as like smaller companies. We recently announced like an acquisition from SPH. Yeah, so really, like dig in really, really deep to find these synergies. Some of them are not apparent, like superficially speaking, but once you discover it and you can make sense of it, you can kind of like force the bullishness into the round. Yeah, I really do think this is the awkwardness, right? I mean, I think most of my peers are cutting costs, right? Yeah, cost control, right? But to have any form of growth, I'm gonna have to invest money, right? So on one hand, I have to save money. On the other hand, I have to spend money. So so what do I do? So for us, I think we're very, very cautious about what our levers are. Yeah, but I do think as startup founders during this time to raise money, right? No matter what, you're still gonna have to prove optimism. You're gonna have to like have some kind of hypothesis for growth.
Right. So let's just moving on to talking about the doing, right? Fundraising under lockdown / circuit breaker, travel restrictions, whatnot. So one of the questions that I keep hearing being asked is, how can entrepreneurs looking to raise funds, especially the ones overseas, right? Reach out to capital providers, like the funds or even for funnel in a meaningful way. You know, like how do you stand out from the crowd? Like to Junxian also say, create that bullishness. Steve, maybe you want to take that first.
Well, particularly for overseas companies, you mean? Companies outside of
maybe,
Singapore?
yeah, overseas and in general, right? Like these days, you can't bump into someone in a coffee shop where the VCs are. So you got to have to be a bit more creative with your emails, your LinkedIn, WhatsApp, whatever.
Yeah, I mean, I must admit, it hasn't been my experience. I think the current climate is beneficial for companies, I guess, overseas as well, because all of the pitch calls and subsequent follow-ups are done remotely. Whereas before, it gave benefit to people, for example, in Singapore, meeting Singapore VCs. Now, VCs here can meet anybody ongoing, and they have more time. And I think, what I'm sure most of us or some of us have experienced is this video Zoom intensity where you do 5 or 6 back-to-back Zoom calls. So the productivity level, the ability to get time, I think Junxian was mentioned this before in terms of ability to get time with investors is still possible. Maybe the conversion rate is lower, but getting time is still possible. And I think that benefits overseas companies. Certainly from my point of view, with the Wavemaker hat on, we've announced 3 or 4 deals in the last, couple of months. Wiz AI, which is an AI company, is Zooblue, which is an eco-conservation maritime business, and Entropica Labs is a quantum computing business. All of those are new deals. All of them were announced in the last few months, but none of them are started during lockdown. They started the process. I think, Veli was mentioned this before, that, started beforehand. So there was some level of, I guess, physical DD process that happened during that time. But certainly from my point of view, I'm still doing a lot of pitch meetings and follow-up meetings, and more probably now than I was before, because it's just a lot easier. We don't have any of those logistical issues that we had before.
Right. Yeah, actually, that's a good point. Veli, you got something to share?
I hope so. So I think for me the key is really anchor investors. So I think it's very difficult to raise money unless from people that you've never met, unless you have your anchor investors locked in, and unless you have the right sorts of anchor investors. What do I mean by that? What I mean is, if you say you're raising 5 million, or say you're raising $1 million, right? And you need to go get somebody to write 300,000-400,000 of that as your anchor, right? And then depending on who that person or who that entity is, you then need to think about who are the people that typically co-invest alongside that high net worth individual, that VC fund, that family office, right? And I think that once you have your anchor locked in, you can then kind of fill out the other pieces of the jigsaw. But I think it's really tough to, I think it's going to be, I haven't seen anybody close a round yet where they didn't know the anchor pre-COVID-19 and pre-lockdown. I mean, so we raised a little bit of money recently and we closed last week, and we actually have some new investors who came in. Some of them have never met me and have never met anybody on the team, right? So it is possible to raise money from people that you never meet, but they came in partly on the strength of, I guess, our pitch deck.
And your good looks.
Yeah, I'm not sure. That definitely didn't help. But I think they came in, partly on the strength of kind of the business, but also because of who the anchor investor was and because of who some of the other co-investors alongside the anchor were.
Right.
So, yeah, I mean, everybody kind of likes to move in a pack and kind of, if you've got some high profile, for instance, if Wavemaker was our anchor, I mean, it would be pretty easy to fill out the round. Because what investors do is you look at the anchor and you say, is this a solid organization? Are they going to do proper DD? If the answer is yes, then you can then kind of, take a bit of a pass on how deep you dig into the DD.
Mm.
Who are the lawyers on the deal? If you've got really good lawyers representing company, anchor investor, CEO, you can then again take a bit of a pass when it comes to really drilling into the legal documents, because you can see that, okay, really solid lawyers, and between them, the anchor investor, the CEO, and the company have raised, X million over 10 years and have worked on 50 deals. So I think, yeah, I mean, it really comes down to, if you go back and you look at why do companies succeed, or why do early stage companies succeed, timing is probably the single biggest driver. Are you in the right market at the right point in time? If you're too early or you're too late, it's just not going to, it generally won't work. Right. The second biggest thing is team. And I think team, you have to, when you think about team, you have to include in that your anchor investors, your lawyers, and all of the other people who together give you credibility as an organization.
Right. Actually, that's a very, very interesting point. I know Steve was talking about deals being closed, but it was pre-COVID. But, not to take anything away from those deals, but I think that investors can still say, hey, look, we got to take a pause and not proceed, even though we've done some level of physical DD. Kristin, what are you seeing? Like, has Funnel closed the deal where it was end-to-end virtual DD done?
I definitely agree what Veli said. I think that having an anchor investor is all the more important in COVID. I don't think we've seen any deals close, without an anchor investor coming in first. So I think we've definitely seen deals where follow-on investment is totally virtual, and those are sort of smaller tickets to round out the round. But I don't think we've seen any anchor investors do everything virtually just yet. But I think that again goes to show the fact that, people do move in a herd, right? And the more you can rely on an anchor investor and their credibility and their lawyers and their level of due diligence, the more comfort you as a follow-on investor can take, right? I think that's extremely important. So I think, when you're thinking about what, makes one startup that can raise 10 mil versus another startup that can only raise $5, I think it also comes down to price validation, right? That's really what the anchor investor does. Right. And it's something that's not just, I think, in the current round, but it's also price validation from previous rounds. And sometimes that is even more important, right? Because you could close a deal, your current round, but how that is going to impact your future rounds, I think is also something that people are quite conscious of, and rightly so, right? Because if you're not raising something at a reasonable valuation, that's going to cause you some problems further down the road. And having that right validation from the anchor investor, I think is absolutely key.
Right. And then for Junxian, your business is very much an offline, physical kind of business. Are there any interesting ways that you have done due diligence with your prospective investors?
So I guess like
videos.
A big part of the fulfillment process. I mean, that's involved trucks and warehouse and crew, right? Yeah. So I guess so far none of the investors have actually gone down to like the work site to kind of check out, how we are managing our warehouse and what have you. So, but I do think what helps is keeping a clean data room. Yeah. So as long as the numbers check out, right, whereby your cost of goods sold doesn't look out of whack, your reviews online, you don't receive like incessant hate mails and stuff like that. Yeah, I guess like that level of validation should suffice, unless there's a problem. Yeah, but very seldom, in fact, never. I don't think I've had a single one of our investors actually went to do like a site visit to one of our warehouses. Speaking to our crew, yes. But that can be done virtually, right?
Right.
Yeah.
Yeah, well, I mean, we're just thinking like, well, the good thing is that we are going to phase 2 on Friday. Eventually, a lot of other economies, other cities are removing lockdowns and hopefully easing travel restrictions, so we don't have to figure out too much about how to, who's gonna do the first brand new deal with a full virtual DD. I guess that really that point, like what Veli said, like there has to be that anchor first, provide that validation. and things go on from there. So I want to move on to this really. Yes, Veli.
Martin, can I just add one thing? So just
sure.
to kind of follow up on what Junxian said. I mean, I think that, part of what we do at Lantern is help people kind of build clean data rooms. But kind of if I go back to sort of earlier, 4 or 5 years ago, I mean, a lot of deals fall apart because people don't have clean accounts, don't have clean governance documentation, don't have a clean ownership structure. And I've seen, and I've personally walked away from a deal, I guess Q4 last year, because I just couldn't get comfortable around the documentation. And this then also feeds back into the idea of needing a really solid anchor. Without really clean data, it's very hard to get a reputable anchor on board.
Okay, so for our audiences out there, we're gonna move to a more interesting segment called key success factors, right? I'm sure that's what everyone is spending the afternoon for. Like, you put a group of startups. I talked about this earlier. You put a group of startups together. They look the same, smell the same, equally talented founders, but yet like their fundraising results can be very different. For the investors like Steve, Veli, and Kristin, what are some of the key success factors that made you, key success factors that the startups that you have invested in displayed that made you say, I'm going to write a check for these guys? Veli, you want to start for a change?
Yeah, sure. I think business plan and funding tend to take care of themselves if you get 3 things right. And in reverse order, they are product, they are team, and they are timing. Right. So if I see a company and I've lost plenty of money following this approach, but I've also done quite well. And overall, I think it kind of works more often than not. But if I see a company with a really solid product and a strong team, and a team that can grow, and they are addressing a problem that people want fixed like right now, not 6 years ago or 2 years from now, and are willing to pay to have that problem solved, to me, you're in a great position as a business, and that makes it kind of very interesting to me as an investor. And so I think if you are thinking about starting fundraising, or even if you're in the middle of fundraising, I mean, I would strongly recommend you go back and you ask yourself, is my time, how do I spin? What's the story I come up with that explains why my timing is spot on? What is kind of very difficult to replicate about my team, and why is my product great? And I've taken this is not like kind of trial and error stuff that I've learned over time. I mean, this is data that comes out of Silicon Valley. So Redpoint Ventures, have collected a huge amount of data about key success factors for startups, and in reverse order, they are funding, business plan, product, team, and timing. So I focus on the top 3 because I can't focus on more than 3 things at once generally. So.
And Steve?
Yeah, I would agree with what Veli said. I think for me, when if I think about what makes a company get funding versus one that doesn't, I think clearly there's a piece around are they addressing, I think Veli's mentioned, are they addressing a pain? It's a big pain. Do they have a solution that can address that pain? Are they able to then monetize that? So there's a value creation piece, there's a value capture piece. Do they show some traction? Do they have a strong team, and do they have a growth plan? So those are kind of like the hygiene factors. But assuming that's kind of in place, I think if I reflect on businesses which have done well versus not done well in terms of funding, I think the one key issue for me is around having a investment strategy. So thinking about the positioning. So why now? Why is this relevant now? the whole process, having an investment strategy, and I spend a lot of time with startups on this whole space. What is the strategy? What's the ideal investor look like? So for the next 12, 18 months as a startup, you're going to have a whole bunch of challenges. And you can do that on your own, or you can do that with the help of your investor. So startup, I think about who's the ideal investor. So thinking about this as a two-way process, thinking about, okay, I need an investor who can help me expand into Malaysia, or I can help an investor who can help me break into the top 3 banks. So thinking about what the ideal investor looks like, and then really thinking about that positioning, ideal investor, coming up with the target list, and then the pitch deck to support that. And thinking probably in phases, so for the next 18 months to 24 months, what's my ideal investor look like? What's the minimum amount of money I want to get to build to the next set of milestones? And then I hit that, and then I carry on. So I think process, you can't do funding in a half-hearted way. You might have a fantastic business, and you might say, well, I've got a fantastic business, I should be able to get funded. But unless you invest the time, effort, and energy into that investment process, you won't get funded. And I've seen time and time again, businesses are 6, 12, 18 months later, they're still fundraising. And then people say, well, actually, is this company even backable or not? So I think there's a bit around a really critical piece for me around strategy and process that really differentiates 2 companies similar. If one has that in place, the other one doesn't have that in place, you know which one's going to get funded. And I think over and above that, I think a big part of this is around, are the founders and the founding team backable? And it sounds really, really obvious, but are they ones which, they can clearly articulate where they are today and where they want to go and how they're going to do that? Sounds obvious, but actually quite often that doesn't happen. They have a level of honesty, so when there are issues or mistakes, they will admit it. So what happened then? Rather than bullshit, tell the truth. We made a mistake rather than blame somebody else. There's a little bit, particularly today, a piece around credibility. So there's a startup I was talking to recently, and I really, really like them. It was a kind of a fintech cross-border payments business. Really like the founders, but they insisted on, despite COVID-19, their business would carry on exploding. And I could see them getting to a 2.5 million revenue in 2020. They were adamant they were going to get to 9 million. And you poke holes in it, and clearly it was not possible to do this. And I spent 2 months, and eventually they said, okay, maybe it's 3 million now, the forecast. So it's a bit around telling the investors what they want to hear, but actually that's not what they want to hear. They want to see something that's prudent and credible, which for me plays again to trust. And is this founding team backable? And then I think coachable is really, really important. So are they willing to learn? Are they willing to listen? Are these founders that you can work with and have a constructive conversation? And obviously the investors are not the bosses, and it should always be a two-way process, by the way. Are the founders coachable? Will they listen? Are they self-aware? And will they learn? And so for me, that makes a big difference. And then the last thing I think for me around the process again is that continual kissing of the frogs, the continual engaging with the investors. It's not just there for the investment moment, but maybe the investor doesn't invest then, but maybe they invest the next round. So continuing the dialogue, so that when you need the investment, you already have some warm contacts in place as well. And that for me means that a company will get funded in the future.
I hope all the attendees are taking down notes. These are really, really valuable pieces of advice. Kristin, over to you.
Yeah, I think Veli and Steve both raised fantastic points. I think substance of the business is absolutely key. Having a good fundraising strategy is something that I think people underestimate the importance of. I think a lot of founders are very much, 100% into the business and may not really, and assume that, funding will come because the business is good, the numbers are good, but I think a lot of times it comes down to telling a story. How good of a story, how are you positioning your company, how are you positioning your fundraising, and how are you communicating that story and strategy to investors? I think keep in mind that a lot of investors have you have 5 minutes to make an impression. It's not half an hour, it's not 45 minutes, however long the call is. Really within 2 minutes, 5 minutes, they've kind of already, they're coming to conclusions about you very quickly. right? So I think, being prepared when you go into an investor meeting and into the fundraising process as a whole, I think is really, really key. And like what Steve said, really taking your time to educate yourself around the fundraising process, being realistic around what that looks like in terms of time frame, what your fundraising size, valuation is, all these kind of key points people want to know. I think obviously there's room for discussion, especially when it comes to things like valuation, timing. But I think it's always good to come in knowing what you want. I think that makes a big difference, and that kind of helps investors also, work with you a little bit. If not, you're not really giving them very much to work with. So that's really something to think about. And I think, like I mentioned, investors make a conclusion about a company or have an initial conclusion within 2 minutes, right? So first impressions really count, and those optics stem from everything from your deck, how you manage your data room, how you're talking about your story, so all these things really make a big difference, right? So it's really worthwhile making sure that, you've got a clean shop front. I think that's kind of how I think about it, right? Before you go and open your store and sell your wares, right? I think that's really, really key.
Kristin, I disagree with you. It's less than 2 minutes. Research has shown it's 1 minute and 15 seconds.
Oh, there you go.
Just kidding. Junxian, do you, you've heard from the investor side. I'm sure there are a lot of the good points that resonate with you. What are the 3 things that you think that you did or didn't do that kind of helped you move your fundraise along?
I guess first of all, I agree with them all. But I guess maybe, yeah, I think maybe what helps the guys and I in our team is that I do think investments are a byproduct. Yeah, ultimately, if you have a good product and you have happy customers, I think that should be kind of like what we manage first and foremost. So with regard to I guess the investments area of it, for us, our practice so far is always, I guess I used to do finance, right? But now I'm an operator. So it's not so much about risk management. For us, I think what we try to pursue is a substantiated optimism, right? So it might be the same coin, but it's just looking at it the different side, right? So what
I like that phrase,
fish. yeah. But to really know your justification behind what you're asking for and why, right? And you have to build it. You have to know your numbers, and you need to know how you're going to operate it. So what that means is maybe for us, as we build a financial model, right, projections, we take a top-down approach, right? So kind of size the market downwards. That's never a good idea on its own, but we do it and then build the model upwards and then build your comps. So kind of look at valuation and multiples from a top-down, bottom-up, and a lateral approach. And if the locus of overlap is probably where the market is, right? So for us, we just want to make sure that we're not insane, right? We call it a sanity check. But ultimately, as an operator, I do feel that, as we build projections, what I really care about is not so much the revenue projections, because, it could go up, it could go down, right? And it demands a little bit harder to control. What I think we really want to be sure of is how we're spending our money, right? The cost, what kind of headcounts, how much marketing dollars are we going to put in, making sure we're creating the correct assumptions and levers behind those. So starting from that, I guess a very operational perspective, right? We know exactly where our strengths are and where it isn't. And I think knowing that to that granularity is very important for an investor conversation, right? Because exactly like Steve said, it has to be able to withstand the whole booking, right? Because, there are a whole bunch of assumptions, right? And I guess what investors need to know is that once again, you're not mad, right? You're not overly optimistic. I mean, we all believe unicorns exist, but we also need to be able to have the resilience of a cockroach, right? At the same time, so finding that little space in between. So I think for us, really being able to justify your raise and justify your valuation, right, with numbers. It's a very important step for the entrepreneur first and foremost, and then subsequently it helps with the conversations with the investor.
Fantastic. So we now move into the all-important Q&A session. There's a couple of interesting questions here. Maybe I'll start with the slightly more formulaic, easier one for Steve, since he's smiling. What recommendation would you have for a B2C media tech startup raising a seed round by year end? Top 5 selection criteria from a VC from the early stage perspective.
Yeah, I think we probably mentioned some of that. So
Right.
I think first of all, assume it's going to be at least 6 months minimum. I haven't been in a fundraise process which has been shorter than that, really, from start to finish. So I assume at least 6 months. So if you're talking about end of the year, you should have already started. And then, as I mentioned before, focus on it. Devote time and energy to it. Don't do it half-heartedly. If you want it to happen, you've got, well, December starts to be a write-off anyway, so you've got probably 5 months. So I would devote some time and energy to it. You know, investors are looking for a big pain, a big problem and demonstrate that it's a large pain, and that pain, you have a solution or an idea which is differentiated enough to be able to solve that pain. Demonstrate that the time is now. I agree with what Veli was saying. You know, in my number one is always around timing. So why now? Should we be investing in your company, your B2C company? Why is this pain particularly an issue today? And why are you particularly able to address that? If you can demonstrate the ability to create value, in other words, have a solution that solves this problem, and then you can show that you can capture some of the value by monetizing through the business model, then you're halfway there. And if you can show some level of traction, it doesn't have to be financial, some level of traction of customers using it and engaging on your service, then that will help. Team is obviously important, and showing very clearly, okay, so this is where we are today, but this is where we're going to be in 5 years, and how are you going to get there, would be my advice. And think a little bit about what is that range of investment you actually really need for the next 12 to 18 months to get to the next milestone, where you can justify a higher valuation and do the next fundraise process.
On the topic of fundraising, how, you know, there are some startups thinking that, look, I'm not good at all these, I'm just going to hire an advisor to do that. Do you see higher success rates, or they just bomb out totally? See.
My personal experience has been, if at an early stage you're using advisor, then it's an immediate red flag for me.
Right.
My personal experience of working with advisors is promise a lot, deliver very little. However, I think at a later stage, so for example, Property Guru, you know, the first 2 or 3 rounds, you know, it was basically me devoting 6 months of my energy to it, while my co-founder, you know, kept the lights on the business. And I think that worked well. It's obviously hugely distracting. It wasn't until, you know, when we raised $120 million with TPG and a couple of others that we had an investment bank helping us, and that was invaluable at that stage, because we had 1 shareholder leaving, we had 3 new shareholders coming on board, including a very large private equity organization. And we wanted someone to manage that process for us. And so they didn't go out and find investors for us, because, to be honest, I'd spent the previous 5, 6, 7 years just talking to investors and continuing talking to investors, and continue kissing these frogs on the hope that one day they'll turn into a princess.
Right. Many have.
So, but they definitely helped in terms of maintaining the speed and the process. So, for example, you know, when you had, you know, one maybe dragging their feet, or one actually trying to accelerate the process to get better terms and catch everyone off guard, what they were very good at doing is managing that whole process, and keeping everyone on board at the same time. And that includes not just investors, but also, you know, 6 different groups of lawyers in that process. So it was a highly complex, quite large investment round, and that's when we used it. And we're probably using an investment bank since then on these kind of processes, because they can help the process. But early stage, I know my experience has been, don't add much value.
Mm-hmm. Okay, that's a great comment, and that's what we actually at Genesis see as well. The guys who take the advisors at too early a stage, you know, tend to be red flags. And I see Veli, Kristin, even Junxian nodding away. Hopefully not because you're getting bored. So last question, we've got time for one more question, and this is really interesting, especially in the light of the WeWork saga. we hear that a lot as well. We are focused on achieving profitability. So given the current environment, are investors more interested in companies on a fast path to profitability or ones with hyper growth, bracket, but slower path to profitability? Anyone want to take this?
I'll take this one. I think it's a really interesting question. And honestly, I don't think it really matters. I think what really matters is something that Steve touched on earlier, which is, can the company clearly articulate where they are right now and where they want to be in 3 years? So whether there's an economic slowdown or we're at the races and there's record economic growth, I don't think it really matters that much. From an investment standpoint, to me, what is more important is that people really understand their growth model. Where are they now? Do they understand where they are now? Are they facing weak demand, strong demand? Is their balance sheet weak? Is it strong? And what does that imply from a fundraising standpoint, from an operational standpoint, in terms of how they want to get to whatever their goal is in 3 years? So that's maybe not like a very helpful answer, but I think to me, it's really, you really need to understand your own business before you go speak to investors. And you need to be realistic. I mean, Steve again mentioned speaking to the startup that was convinced until like a week ago they were going to do 9 million in revenue this year, but now I think it's more like 3. Okay, it's really important to kind of iron out that wrinkle before you get in front of investors, right? And I've made that mistake in the past. I've gone there and I've sat there, and sometimes I've sort of maybe over-egged the pudding slightly. And when you get in front of a really good investor, they're going to turn around to you and they're going to be like, seriously? It's like, okay, we're 75 seconds in and you're done.
Right.
Right. So I think you've got to really understand your business, and you've got to be really honest with yourself about its strengths, its weaknesses, and its prospects. So it's less about hypergrowth versus profitability. It's more about, again, the management team, timing,
right,
business plan. So yeah, not a very good answer.
No, but really back about how hard have you thought about your business before you've come to ask me for money, right? I mean, it all boils down to this. You know, I can't believe how quickly 1 hour has gone by. I really enjoyed myself. I really learned a lot. Definitely would think through the way we do business, fundraising, etc. with the tips and the pro tips and war stories you guys have shared. Steve, Veli, Kristin, Junxian, really thank you so much for your time. And I'm sure our attendees appreciate your sharing, very, very candid sharing as well. We are, so we've come to the end of this webinar. Our dear audience, we hope you have learned much and taken sufficient notes. We'll be sending the links to the video in a couple of days time, as well as we'll send an email with the contact points for our esteemed panelists. Should you decide you want to invest in their companies, invest with them, or ask them questions. With that, we wish you a very, very good afternoon and a safe rest of the week. Bye, everyone.
Bye, everybody.
Thanks, everybody.
Bye.
Thanks, Martin, for organizing.
No problem.
Thanks,
Cheers.
Martin.
Bye-bye.